All right, welcome everybody. This is first a sound check. This is going to be a PUG meeting for the Algo 17 Extreme version 2.18. How it works, a couple of good questions, so we're going to get into that. Perfect. I love you, Ruth. Thank you so much. It's always nice to be able to log in to your own platform, right? If you weren't logged out on the other computer. Right, anyway. All right, well, there's something here for everyone. And I know many times we've talked about the one main item that will help traders differentiate about trading, and that would be the environment in which we're trading, average true range. So I do want to get to the questions. First off, George, I see your question about the British pound. We could work on that if you come into the live trading room. Perhaps I'll just share the you must be referring to the one in the live trading room, the British pound strategy for the live trading room, I am assuming. So if you can take the time, Tom says the audio is cutting in and out. Everyone else says sound is good. So Tom, here's a situation too, with everyone working from home, kids at home, grandparents at home, FaceTimers, I don't know, streaming videos, Netflix, movies. I'm pretty sure that the internet is being stressed at massive capacities right now. George, for the algo settings for the British pound, I normally don't share what's in the trading room except for trading room people. But if you come into the room, I'll give those strategies to you. If I can't get to it, or if you can't come into the room, then I'll just do a quick YouTube video over the next day or so. If somebody today can remind me to do a quick synopsis tomorrow, I'll have it uploaded to the YouTube video of our Algo 17 pound settings. So we'll try to keep it. I don't like to do that because it's out in the open, but I think people would need to know what PPS is, etc., HCDs, and all that kind of good stuff. So that'd be fine. So that's the ones that are in the live trading room. We'll get and so that's how I'll handle your question. We'll just do a YouTube video, and then we'll ask your constituents and the members right now. Like if Ruth could say, "Hey, person, remember tomorrow? Last night you said you were going to do a quick video on the pound settings," and then I'll do that, and then it'll be recorded, and we'll upload it on YouTube, lickety split, and be there by tomorrow noon. Okay. Well, thank you all for joining me. It's been an interesting quarter, to say the least, since the last time we've met. It certainly has been an interesting year, without a doubt. And every day gets, I don't know, what do you want to say, weirder and weirder, right? From wearing masks, not wearing masks, and, people traveling still without having any hindrance. People are able to fly from unbelievable Newark, New Jersey, Saturday before Easter, and apparently land in Palm Beach International Airport and not have anything other than a form to fill out. Are you healthy and where are you staying? Boom. And then that's it. Walk right off the plane. You would think we would have at least those little thermometer temperature things that they're zapping people in their foreheads to say, maybe at the very least, that kind of a check. When is the economy going to get back together? That's, I guess that's reserved for other people and other things. Our job is to talk about the Algo 17 and answer a couple questions. So Brian asked a few questions actually, and so I'll get to them. So the first thing I'm going to do is I'm going to take this blank ES chart, and I'm going to add Algo System 17 Extreme version 18. That's the 17th, this version 17, but it's, again, what is it? It's the 18th version of 17. So I don't know. This is actually, I don't know how many releases. We haven't done one in a while, and we don't need to do any updates right now. And we're going to go to Format, and I'm just going to randomly select a couple things. Now, when randomly select a couple things, meaning start time, end time. So I'm just going to kind of say, like, all right, maybe 8 in the morning, and we're going to go end time, which is military time. Let's go 1600 And we're going to, for day trading purposes, exit end of day, that's true. So 0 is false, 1 is true. We've done this before, so I want to get to Brian's question, which is first and foremost more about stops and scale outs. And what is the scale out ratio 0 versus 1 on a 2 contract lot is one specific question. In order for me to do that, I kind of have to build something for this thing to pick up some signals to demonstrate that. So what I'm just doing is saying, let's say I am only capable of trading during the day from 8 in the morning to, say, 4 in the afternoon. And we all know Globex closes Eastern Standard Time at 5. So I don't know if I should take any new trades from 4 to 5, but by gosh, I want to be out at the end of the day. Now, in this version 18, we define the end of the day as the open of the last bar. So if you're trading a 5-minute time frame, keep in mind exit end of the day is not the close, because the close would be exposing you to an overnight or that next time frame. Remember, you can't sell in TradeStation literally on the close. You have to, it would be the next open, and if it's a 5-minute bar and the close is the top of the hour at 5 p.m., well, that makes it kind of darn difficult to be out. You would be holding it in that 1 hour time period where the market is closed. Now, you can probably set your own time frames there of what end of day is: exchange time, central time, Eastern time, open outcry, Globex time. We are using Globex time in this case. So exit end of day is true, which means that it will exit at the open of the bar, not the close of the bar. Now, that's important because if you're running a 60-minute program, you're not going to be out on the cash market at 4 p.m. You're going to be out at 3 p.m. on the open. So that's just a little information. If you're doing a 60-minute swing trading model, it's probably not something that you would want to be exiting end of day. So first and foremost, know what you're trading, what your time frame, and your expected holding period. If you know you're a day trader, you'll be out exit end of day. You're going to want this function to be number 1. All right, position sizing. Generally speaking, for commodities, we're not going to just say get me into as many positions as 100,000 will allow. That's my account size, or risk value, which is number 2. 1 is position value, cash amount. 2 is risk amount, cash amount. And then 3, we need to change that, would be to show you the position size. So Brian says, maybe a quick explanation of trailing stops. Is the trailing percent that of the highest price and continues to follow trail? So I'm going to explain what that is again, Brian. And then we're going to explain the scale out ratio. And then looking at draw lines, blue, your question is, you believe what red is, you know what orange is. Blue is the profit target unless you've overridden. It's the profit target of your risk reward, but if you have a setting that says don't get out at the profit target, trail my stops instead, yes, it's going to blow right through your blue line. So that's the interaction between the different settings. It's pretty advanced. It's the most incredible program in any professional trader's hands, let alone a retailer's trader's hands, that I think technology allows individuals to have in this environment. It really is. It's just it covers pretty much everything. You can optimize it, you can customize it, you can actually make this to just be a very simple program that says get me in and develop a scalp model that says just get me in on defined buy signals or sell signals with a defined profit target and a hard stop. You don't need all the bells and whistles, which gets me down to my next point and also your question. So we have set this to position calculated 3, which is, and we're using 2 lots. If I'm going to use 2 lots, then I want possibly an idea to scale out 50% minimum, right? If I was going to scale out, if I have this as a one lot, then I can't scale out of a one lot. I mean, all I can do is ride it, trail a stop, or get out of the position entirely. But with trading at minimum of 2 lots, then I can at least get out of half the position. If I use 3 lots, then I can get out of 33% of a position, thirds, right? Get out of 1/3 and then trail the stop or optimize it. I can optimize what you're dividing your position offset by. So if it's 2, 50%, 3, 33%, right? 4, again, 50%, or maybe 4 could be by increments of what? 25%, right? That would be get me out of 1, get me out of 3 would be 75% of a position. So the math numbers, you just have to have a little bit of cerebral input and logic, but it'll do what you're asking. So again, when we get to the point based off your position of what you're asking it to optimize to scale out, make sure that your number is divisible by your denominator. All right, so we're going to use, again, 2 lots. All right, money management. All right, if you have 5-minute bars, here's the interesting one. If you have 5-minute bars that are making, I don't know, what do you want to call these on average? I don't know what the average is. I could punch it up by using ATR, but just by hardcore look-see, on average, this looks like a 10-handle 5-minute bar. This looks like a, let's just double check something here. While I have this box open, you know, I'm just going to round up and say this bar right there looks like it was around, what, 68, 69, and had a high of around 78. So there's about a $9.450 range for one 5-minute bar. Some of these bars look like, for the most part, they're around $375 on average, except for a couple of them over here, like that one bar looks like about a 15-handle move. 15-point move in a 5-minute bar. Gang, I keep telling you this. Listen carefully. Not more than less than a year and a half ago, no, at Christmas time, we had a day where it was a 10-day average true range was 17 points at Christmas. Do you remember that? Those good old days? Now you got 5-minute bars that can exceed, in 2 bars, you've exceeded what we were doing in an entire day. So again, $500 max loss on 2 lots probably is an underachiever, unrealistic amount. You're going to have to say, if you got again, 1 bar, 2 bar, whatever your ATR is, you might have to jump this up to maybe $2,000, right? Why? Because that's $1,000, 20 points. Now, you say, well, that's too rich for my blood. Then you know what? Then it's too rich for your blood. You're right. It just, you know, that's the environment we're trading in. So you can't force what you want out of the market. You got to conform to what the market's doing. And so that's where the algo optimizer will help you uncover what is your risk. Maybe we need to filter out better trades, and maybe you need to go with micro futures, or better yet, a different product, like maybe gold, or like George Vallier, who wants to see the British pound that we run in the live trading room. Now, crude oil, which is trading at just under or around $20 a barrel right this, I don't know where it's this very, very second, but the CME raised margin requirements. And then depending on what brokerage firms raised the margin on top of that. TradeStation asked for 200% of what the initial margin requirement is, over and above the increase from CME Group. So what they're trying to do is not keep people from trading. What they're trying to do is help people reduce their exposure to excessive risk. When the exchange itself, even though crude oil is at $19 and $20 and trading at $22, when they see that small speculators and there's too much money on one side and the market's exposing to risk, they will raise the margin requirements. Why? Because if everyone that's on the wrong side of the market doesn't have enough cash to cover their losses, the clearing firm has to do it. And if the clearing firm has enough clients that run them out of business, other clearing firms have to back up the one clearing firm that lost money. That's why the exchange has a committee to raise margin requirements in the futures. And that's when you do see margin changes like that, it's generally a heads up that there's a big change in price direction coming. By the way, something I wrote about 20 years ago in my first book, margin rate changes. When you see a margin requirement change by the CME, it is a harbinger, a warning shot that something is going to change. And, that's something that the exchange did to the Hunt brothers way back in 1979-80 in that big silver fiasco. They raised the margin requirements. The Hunt brothers couldn't cough up the dough. They were over leveraged. And what did they have to do? They were forced to sell their silver holdings. There go the crash of silver from $50 straight to I think $1.75. It's a little history for you. Being over leveraged in the market can make you money quick. It could also put you in the poorhouse. In the movie Trading Places, Dan Aykroyd and Eddie Murphy, they're getting ready to go to the exchange, which was, again, in New York City. They were leaving Philadelphia. And Dan Aykroyd, Valentine, says, fear, that's the other guy's problem. 1 minute, your kids are going to Harvard, and the next minute, they're repossessing your Bentley. So, again, that line in the movie was, you're either going to be extremely wealthy or extremely poor in this business. And that's why it's important to understand if the heat's too much, get out of the kitchen. If the risk is too great, then you either got to look for a new product or you got to try to optimize what is a good strategy for you. All right. So money management, max trade loss, this I would have to tell you, you can optimize this as best as possible, but you can also just simply look at the bars from just from a logic standpoint and say, gee, what's the average of these swings? If I buy a breakout, a PPS buy signal here, and my stop has to go there, what is the distance between here and there? And if you see that the market's at about 20 points, that's $1,000. And if you're in two contracts, well, that's $2,000. So a simple little PPS buy signal on a 5-minute bar in this environment, it really does mean something a little bit more, right? So maybe we don't want that as a trade. Maybe you need to reduce your exposure or say, hey, I can't take those trades. Maybe I need to take something like $800, and if it doesn't get me $800 worth of risk, then I don't want that trade. The trailing percent. All right, exit strategy. This is part of Brian's question. It's a damn good one too. What this thing does, exit strategy, it says start trailing a stop in the market. And again, it has to go back down here. Are you taking buy signals? In this situation, I'm going to go with 1, reversals. I'm going to take buy signals. Risk reward ratio, 1 risk, 1 reward. I'll probably move that to at least 125. Moving average 5, period moving average, and based on a close. The sell signal, let's go with 1. A risk reward ratio, I'm going to go 2.15 because markets go down a lot farther and faster than they go up. So a risk reward ratio might be best suited in this environment when the markets are more in a bearish type of mindset to go with a higher type of risk reward ratio. And you have to optimize this out. Now, as you build a strategy, let me ask you a quick question. How many times have we traded in an ATR where the end of day, 10-day ATR is something like 125 points a day? Anyone have a guess how many times that's happened in history? Never, never. In fact, if you try to build a strategy and say, well, I'm going to try and look at a 6-month backtest study. How are you going to do a 6-month backtest study when we've only been in a maybe 8-week period of insanity of higher ATR? So you need a strategy, literally, not to curve fit, like to adjust each signal for one trade, but you need to maybe only do a backtest study for the last 4 weeks with the assumption that the higher IV, this environment we're in, will continue for another 4 or 5 weeks, maybe. or 3 more weeks, or at least the next week, right? So number one, I think the whole thing about this is you can't lose sight of the environment you're trading in. And that's the key function of trading. This program is only going to give you the trades that you asked it to do, and do it automatically if you want, or it'll highlight the trades and you could say yes or no by putting up your automated execution permission, which is right here. Automatic execute account, and you can say, hey, I want to confirm it. In a fast-paced market, you probably, if you trust a setup that you're going to do that I'm going to share with you in a minute, and say, I just want to take sell signals in this bearish market, or if the daily's in a sell and the 60 minutes in a sell, then I only want to take 5-minute sell signals. And you can pretty much set one up like we've done at the Razor Focus class, where we had a daily long only SPY, we had a long only 60-minute, a short only 60-minute, and a long and short 60-minute, right, for the Razor Focus gang. So why can't you do that for the S&Ps? A long and short, a short only, a long only. And when you are more impressed with or more in the opinion that the market's bearish, then I only want to take short signals, you already have it, right? And then only, get me out on a scaling function, get me out with a quick profit and then trail the balance. And that's part of what we're doing to answer Brian's question. What the hell is this trailing stop function about? And what is the scale out ratio 0 versus 1 on a 2-lot contract? So that's what I'm getting to. In order to answer those questions, though, I got to kind of build something that takes a buy signal and a sell signal. All right. So we're only taking buy signals here if it's above a 5-period, a PPS buy above a 5-period moving average based on the close. Why? Because H stand is 1, 2 is L, and 3 is close. Now, a true momentum breakout would probably be, if you think about it, a moving average of highs, and that's why we gave that function of high-low close divide, and you can have that HLC. So I would want to, if I'm going to take a buy breakout, I could go with a last conditional change. Okay, great. Or I could go with maybe a 5, a 10, a 20, a 50-period moving average of the highs. The thing is, I don't know what's the best combination. A 5-period moving average of the close, I don't know. So guess what? We built in a function that you could optimize that to figure it out. Just like a sell signal. Do we want to get a sell signal on a last conditional change, or possibly a sell signal of a moving average of the highs? No, we'd want a sell signal of a moving average of the lows. If it breaks, if a moving average of the lows acts as support, if a market closes below that moving average, that would be a bona fide reversal signal, and so better confirmation. So again, you have, the user, the ability to create that concept with these two functions to help you define a better buy signal, or a filtered buy signal, and a more stringent filtered sell signal. So we're not going to optimize and build a strategy together in this class. This class is just to design to answer your questions and to review how's the best way of using this product moving forward. Now, months ago, I want to point out to you, every other bar, wild ranges, were starting to look like dojis. And so I turned off the high close doji in that environment. And because the high close doji, we were seeing ridiculous amounts of risk and false signals, I turned it off for right now. And we said the 5-minute bar, especially if you're trading overnight action, you're probably going to get a lot of bars that look like dojis. Here's one right there. That's not a low close doji. That's already in a downtrend. And I can't change it. It's right there. It's the bar right here that I've got lined up. There's the open, there's the close. That's a doji, and that's after a downtrend. How the heck is that a low close doji? It's not. So again, too many false signals. And if you're trading at 2 o'clock in the morning, that would have been a great PPS sell signal, and it closed below a bunch of last additional changes. It also probably closed below a moving average function too. But if you're not trading at 2 in the morning, then you wouldn't have taken that short position, right? All right. So again, when you build a strategy, you're building a strategy that you can monitor your computer to make sure that your internet's still connected. The last thing you need is everyone to be staying up late at night watching some Netflix movie, the Lion King guy or the Tiger King guy, or I just don't understand the popularity of some of these shows. But I guess that's something that's popular. I have no clue why. Sport fishing shows, I have a different interest. You guys have different interests as well. How-to videos might be good. If you're bored out of your mind, how to maybe paint your house. If you find out that painting your house really does suck, and if you have arthritic problems, by the time you paint a couple splashes on the wall, the next thing you do is you got to call a real painter to come in and fix your problem that you started. And that's why I'm not allowed to do things like that. But anyway, I digress. Sorry. But if everyone's up on the internet and your internet connection goes down and you're asleep and you're just relying on this to make you money while you're asleep, that's not what we told you to do, and that's not the smartest thing in the world. If you're okay with the risk that could be associated with 1 or 2 bad trading scenarios or a market crash and your system went long, or maybe something happened and you can't monitor to make sure it is connected, then I would suggest don't trade, because that's the essence of this program, is to make sure that you're connected to the internet. All right. So if a market is overnight too much risk, or the signals aren't looking good, like too many dojis, don't use the high close doji and don't use the low close doji. Higher time frames are working well, 60-minute, daily, for example, weekly, but those might be something that's a little bit different for a trader rather than a day trade. Max trading bars. What does the max trading bar mean? Well, that means that after so many 20 bars in this case, it's going to get you out of the trade, whether you hit your profit target or not, or you're trailing the stop. So if you want this thing to trail till hell freezes over, but you say, hey, at 20 bars, that's all I want, that's, again, a function that needs to be optimized. I have found that on a 5-minute bar, it's between 28 and 34 bars is one holding period that works a little bit better. Do you take market orders? Yes or no? That's another optionable, optimizable function. What is the difference between this enter trade market order true or false? Market order true, when it gives a signal, it gets you in the next open. However, if it's false, it will get in on the signal bar, a tick above that signal bar's high, plus a tick, a tick plus 1, excuse me, is a better way of phrasing it. So if you had a buy signal, it's not going to get in. So example, if this bar right here generated a PPS buy, you'd say if market order, it would have gotten you in, and then it would have slammed you right back down. An actual enter trade market order, you could optimize that and it'd say, hey, you know, it'd be better if it's a true buy signal, like here. If that was a PPS buy, you'd get in on the open and it got slammed. Why not stop me in on a high? If it is a true buy signal, then it needs to make a new higher high. Now, that might add a little risk, but it'll also filter out some bad trades. So that's why you want to make sure enter trade market order. That might help reduce false entries. All right, draw lines. Lines are going to be drawn where your entry, your stop, and your initial profit target. All right, Brian, your profit target's going to be overridden if you say, don't scale me out. And if you optimize this, it has start at 0, optimize 1. So it's the difference between 0 and 1 is 0 is false. Get me out at the profit target. 1 is true. Keep it trailing and let the trailing stop function and override that profit target. Don't get me out at the profit target. and 0.5, not 0.05, 0.5, you're optimizing. Should I scale out? Should I trail out? Or should I hard stop or get out on hard limits at the intended profit target? And that's your optimization function on your scale out ratio. Now, I've just set only buys for PPS and only sell for PPS. This function, start trailing, it's going to kick in an emergency stop if it gets, and the way it's reading now says 80. That means if the market is almost 80% of the distance between your entry to your profit target, it's going to jam a stop in, protecting you at 10% trailing stop. This will override anything else we're going to share with you. So you definitely want to optimize these two. In an environment where you got a 1-to-1 risk reward ratio and maybe perhaps you got 20, 30 point ranges in the market, I would say at least 30% would be, and maybe it's 27, maybe it's 39. You have to optimize that yourself. But I wanted to make sure that we had at least an understanding of how the relationship is between what you're asking the exit strategy function to do and you're defining your risk reward ratio. So I'm just going to go ahead and hit OK and optimize this. Again, this is not a class where we're building a strategy together. So I'm not looking for performance here. What I'm looking for is a strategy to help Brian answer the question, as well as you guys to have a better understanding of the relationship of these functions. Okay, so we go back up here and we're going to come up with the next level. And one of the things that we added was, you see this function where it says set break even on partial position. So let's say, for example, you're scaling out, scale out ratio, and it got out. What does it do with the balance of that position? It may have a trailing stop that's at a loss. So half the position took a profit and the other half might take a loss. Instead, it's going to move your stop on the balance at break even on a partial profit. So like maybe 1 or 2 ticks is what that would optimize out. So that gives you a chance that maybe half your trade gets out and the other half is letting it ride and letting the trailing stops kick in. But what if the trailing stops are too far away? So in the live trading room, we have one on crude oil that it gets out on half the position and trails the stop on the balance, but it doesn't have that function activated. So sometimes we see half the trade takes a profit and the other half takes a small loss, reducing and giving back some of the profits of the overall trade, right? This would ensure that no matter what happens, if you got out and the market starts to plunge, it's going to have a stop jammed in there, probably a tick better than your entry. So that's another function that's like, wow, it's another wow moment. Now, that's what the difference is. What is a scale out ratio of 0 versus 1 on a 2 lot? So how do you do that? On a scale out ratio, you have 0 means if you place 0, it means it's going to get you out of, it's not going to trail a stop. If you have 1, it's not going to get you out on the hard stop. It's going to get you out on the trailing stop. It's not going to get you out at your profit target or that blue line. In an increment of half, it'll then say it'll get you out of half your position. Okay. Next, what is these last conditional changes? So it's real simple. Bear with me a second, trying to get this up here. All right. So dynamic last conditional change would be real simple. These are the last conditional changes, and you would say, I want to use last conditional changes. And one thing that we come up with in this environment is sometimes the last conditional change, it's not as effective in the very short term. I mean, the market looks pretty good, like it won't until it closes below a last conditional change, and then it really starts to see meltdown. So that's why we kind of changed last conditional change and gave you the ability to optimize dynamic exit. So if I'm not mistaken, we answered the question, is the trailing profit percent of the profit or the profit target? And I already answered that question. It's the percent between your entry and your intended profit. Okay. If your intended profit is 1.25 to 1, by the way, so a buy signal, and your risk reward is 1.25, when the stock gets 30% close to 1.25 profit, it's going to jam that stop, protecting 10% of the trade. Okay, so that's the profit percent functions based on your trade. If you have the scale out ratio that says don't get me out at the profit target, don't scale out either, just override and trail the stop, then it ain't going to get you out at the blue line. That's what that is, Brian. Okay. Now, what kind of stop should we use? LCCs or dynamic? What is dynamic? Dynamic is a change or a function, a difference between the whichever is the greatest of a last conditional change and the ATR, the function of ATR. So if this is, for example, over here, these last conditional change look great. You get into a long, and in your function, your stop is below the last conditional change, and an average of those. The dynamic would be the average of those. So the last conditional change, one is here, one is there, one is here. The average of those three is about right here. So it's not going to be that last conditional change. It's going to be a dynamic one. It takes an average. Here's one, there's one. It's going to be the average. It's going to be just slightly below the average of those. And so even that is not going to stop you out. This probably, that little volatility move right there would have stopped you out of everything before it proceeded to go up. So no, it's hard to combat that type of volatility or shakeout in the market. So that's what the dynamic exit does. It combines the average of last conditional changes and puts it a little bit further rather than using the exact last conditional change or the last one, right? The next one that I wanted to put out hold on a second. All right. The next one is the compression exit. What is compression exit? And that's why you can optimize. You can optimize all these three at the same time. So if you optimize this and say, well, what's the best profitable way of trading in the market? Do I want a last conditional change, the dynamic, or compression? Now, I think if I'm not mistaken, there is a question about the compression and what does this mean with the ATR. So compression exit has a combination between dynamic but time. So as time goes forward, it will tighten up the stop. Many times you'll optimize a program or a strategy, and guess what happens? It's going to use both the dynamic and the compression. One will take over and override the other. The compression exit will not kick in this case until, and you would optimize this function, compression is not going to even turn on in this case. It's the way it's reading until we have two ATRs, and then it would kick in. Well, what's an ATR in this case? Based on a 5-minute ATR. If the 5-minute ATR is 10 points, then it's not even going to kick in until it hits what? 20 points. So you're telling me that you're not going to have any stop working until the market breaks out above your entry by 20 points? Hell, that's a great trade, $1,000. By the time this thing kicks in, it could come all the way back down. No, that's why you would want to use possibly a combination of dynamic and compression. And when you optimize this function of start ATR, you can use less than one. Okay, so you can go a half of an ATR. Okay, you can actually go a quarter of an ATR up to maybe 3. I don't think in this environment I would use 10 ATRs, but if you really wanted to look at it and say, would it give me 10? Sure. I think if you just use your logic skills and say, I'm asking this thing of an ATR to start kicking in at 2 ATRs. What's the average range of this market? And it looks like, and let's go over here and hit cancel. And if you go over to view data window, now this is 9.5, excuse me. But if you go over here and you go to insert analysis technique, and even on 10.0, the same thing would work. If you go all the way up, and I believe it should be average true range. All right, some computers, platforms, I think Thinkorswim just say ATR, or Genesis says ATR, and this one says average true range. It spells it out. So if you go, okay, here is a Wells Wilder format your analysis. Wells Wilder used a 14 period because he called that half a cycle, but once again, the ATR was used for an end of day function back when he created this. So we're not doing an end of day on the market. We're doing an intraday. So on an intraday, what makes sense? The higher the time frame, the less sensitive it is to the market movement. So you probably would use for day trading somewhere between 5 and 10. I definitely wouldn't use 14. So you go over to input and you can change this to, if you want to go half that time period and go 7 periods, you can go 7 periods. I think 7 is what, almost the middle of, pretty much, it's not almost, it is pretty close to the middle of 5 and 10. So we'd hit and close. So you're trading in a market environment on average during the open outcry session. I'm sorry, a backup job. This just populated right here, and I need to cancel that. My bad on that, gang. All right. So the market's closed now, and it stopped really, trading. Wait for the data. This should pop. There we go. So for the most part, at one point during the day, you've got, here's your 7 period ATR at 10 points. All right. So what's the average of the average? So the average is probably 6 points of ATRs, the average of the average. I mean, here's the low, the mean, and the mode, and the medium. Your average is probably around 6 points in the S&P. So that's $300. So at the height of this movement, when we started the day at around, again, double check something, go to format symbol. Time zone, this is where you want exchange time would be Chicago. This is local time, so this is Eastern. I'm in Eastern Standard Time. So I generally have mine at local time because I know what I'm doing. When I'm trading, it's local time. So the market opens up, the cash open outcry session opens up at 9:30. So by 9:30, you're already sitting here at around a 7-8 handle ATR in the marketplace through this chop and slop. The first hour is almost brutal to trade in that environment. People get chopped alive a lot of times. Another thing is, if you don't understand from where did the market come from, it went through a huge trend to the downside, and we walk in the open outcry session, and then we're faced with this chop and the slop. Versus overnight, nothing happened, and then we come into the day with maybe the potential for a trend mode. Okay, it's kind of a different scenario. Like the other day, the market had, look, overnight from 1, 2, 3, 4, 5, 6, 7 in the morning. That's what we would call chop and slop, and then we got in the trade for the day, trend modes. So sometimes you got to be watchful of what your environment is from overnight action into your day trade action. So what is the condition? In order to figure out what the market might do, ask yourself, well, what is the market condition and where does the market come from? The market condition was overnight in a strong downtrend, and now we come into the open outcry session. Let's see what happens. We know that we also have an increase in ATR. Well, that's again another little observation to help you guys. When you have an increase in ATR, it's kind of indicative with a market that does what? Goes down. Markets go down a lot faster than markets go up. So the use of these tools of helping you to navigate and take full advantage of the algo optimizer, I think is going to really give you guys first off, you have more information now how to build a strategy based on your current market environment. Once again, I want to just change this over here and just to share with you the kind of environment that we are dealing with. So I said 125. I was wrong. It's 121 right now. So we've seen the S&P 500. I mean, we've just not traded, by the way, a 10-day, or this is a 7-day, once again, a 7-day. This is a daily chart, so I'm asking the ATR to give me the average of 7 periods. And as we went through the the middle of March, we were in about a 200, at one point, a peak of 250 S&P points. I said S&P points, not Dow points. S&P points a day. That will rattle anybody's nerves, for real. So again, the key is understanding the type of environment we are in. And I mean, this is unprecedented. None of us have ever traded in a period of S&Ps for that long, for this much volatility ever. If you recall, back in December of 2018, was the first time I think we actually hit for a month 10-day reading of 92 or 94 points. And that, my friends, was pretty brutal. We just surpassed that and made new history book rules, or I guess you want to say we just rewritten the history book. So we're trading in it's just enormously unprecedented time. I'm very proud of what we've created because the algo optimizer allows you guys to work or not work orders, as well as take advantage of market opportunities. And it's just a matter of defining what you want to trade, defining your risk, and knowing what is the environment I am trading. So by having a little clue of ATR, and that's why a lot of strategies and systems, most of them fail over time. And the reason is because they're built in environments where everything's stable. And then once everything goes haywire, by the time someone builds a strategy and back tests it and everything looks great, and then he puts it to work, guess what happens? The market conditions change. Okay, so a long only strategy wouldn't have worked buying the dips in something like this, right? So I think having a combination and a concept of, and maybe that's the whole purpose of why when we put this together, we have these PUG meetings to say, how do you make better use of your program? I think it's by having not just better analytic skills, but also having an idea of what to look for with the kind of environment that we're trading. And so that's one of the key elements. You know, let's take a look at other markets here. We're going to go with crude oil. So here's an interesting concept. Look at you would think, why, if crude oil's so cheap at $20, I mean, let's face it, it's pretty cheap. Why does the exchange want more money from us to trade when it's cheap at 20 bucks? I mean, you would think at $60 it's riskier. At $60, shouldn't it have been riskier because the market could fall and you could lose more money? No, because the environment, look at the ATR. The way the market was trading on a daily basis, the ATRs, I mean, we're $3 ranges when the product's only $20. So again, the intraday volatility is like, if you think about it, 10% movement a day. This is more like 15 to 20%, 15% of the value of the market. 15% is what this thing's doing on an average daily basis. From $4.50, holy moly, to $3 back and forth. This thing is moving. It's unprecedented. So that's why small lot traders and retail public, you get into it. Oh, it's only $20. I can trade crude oil, but it's moving $4,000 a day. $4 moves. And if you're on the wrong side of a $4,000 move with more than one contract, if you have a $10,000 account and you took a $4 move against you on 2 contracts, you've just lost 80% of your account. You're out $8,000 on a $10,000 account. Makes it kind of hard psychologically and financially to come back without wiring more money in, right? So again, it's not that the price is cheap. It's not looking at the trend. It's what is the condition of the market that's trading day in and day out. And ATR is going to help you to better understand the kind of market settings you should have. So that's number one. All right. Then let's just take a look. I think George was asking for this, the British pound, and then we've solved that issue. I mean, you take a look at the British pound or any other markets for that matter, and the use of ATR will help you start to maybe visualize what is it that you're really trading and what is it you're asking of a system to do for you. If you've never traded a market in again a 400-point range on a given day on average 7 days, I mean, every day is over a 400-point range. That's another spike in not volatility, but spike in how the market's trading. If you have a system that says I only want to take 10 or 15-point risks, you can't be trading that market. I mean, by the time you get your fills are going to be maybe 10 points wide as a market order, right? On a 400-point range. So it's pretty, that's called slippage. So again, using ATR helps you to define maybe your risk parameters. And again, if you're going to start to build a strategy, how do you build a strategy using a whole year's data? Because you're building a strategy that says on average, here's what my trades would do in that environment with this type of ATR. When you start seeing ATRs fly up like that, and I mean, it makes it kind of difficult, right? You're going to have difficulty in maintaining maybe some profitability or execution. Now, that's not your normal market environment by any stretch of the imagination. But what's interesting is, where is ATR right now relative to its historic ATR in the British pound? It's almost like back to normal, right? Would you agree with that? I mean, it's at the higher end, but it's closer to normal than, say, the S&P 500. The S&P 500 has, I think, a 5-year historic ATR of around 28 points. We're at 121. So this is in the British pound is actually now back to closer to its 2-year. If you think about it, I mean, that's 1 year, that's 2 year, 3-year historic ATR in the pound. Just taking an average of a look going right down the middle, not looking at the high, not looking at the low, just looking at the middle. right down in the middle somewhere there is about, what is that, 125 points, and here we are at 145. So we're closer to its norm of trading in the pound. Crude oil is not. If you take a look at bonds, for example, well, that's pretty crazy as well. These are daily ranges. I mean, this is insane. I mean, holy moly. I mean, guys, this makes for a very unusual trading, all right, for any system, So please, I hope I harped a little bit more on how to utilize ATR and what's your environment to identify the environment. You can't just randomly build a system without knowing the environment you're trading. Are you trading in a historic IV market? Are you trading in an unrealistic market environment that we've never traded in before, and you're asking for a simple day trade program? If you are, you know, I don't know how to explain that any easier. You better understand the environment you're trading. And so I think that's the concept between having unrealistic expectations and being more grounded and better educated. And so if the settings or the risk is too great, then don't do the trade, or look for other markets that have probably have returned back to their normal tendencies. Crude oil is not at its normal tendency. Let's take a look at this one, gold, by the way. Gold has been a pretty decent trade for our trading algo in the trading room. But boy, I'll tell you what, gang, $52 7-day ATR, that ain't a normal one. I mean, over the last few years, whether it's gone down or up and down, we're pretty much almost four times the average. Here's a nice little uptrend in the market. That was a brutal breakout, right? So it's the condition of how the market's trading. By looking at that ATR, this will help you say, gee, how do I go and build a back test study that says, here's the last 2 years and my performance is great? How can you incorporate that? Because you just don't have the same type of volatility right now. So just thought I'd bring that to your attention, and I do hope that I answered a lot of your questions that you needed. They were some really good questions, by the way, and I thank you for that. And if I didn't answer all of the questions, forgive me. I just wanted to make sure that we kind of gave you guys a better insight as to what's going on in this world. And thank you very much. I wasn't drawing. I was are you saying that my mouse didn't show up? Perfect. Great. Sorry about that, Jay. I had a mouse over there, and the mouse should have been showing. Apparently, it didn't pick up the hand. I wasn't drawing. I was just actually had the hand, so didn't see the hand not being projected. I think that you can see what I was referencing, hopefully, though, in ATR, right? I mean, at the very least, all I was, and it makes it hard not to show you because it's apparently not picking up. Oh, I love technology. It's just wonderful. So anyway, the scale out ratio, Brian, has to do with the scale out ratio scale out ratio does not have to do with the trailing stops. No. Zero, yes, 0 means trailing stop to get out. 1 means get out at the target. Don't use a trailing stop function. And it's a matter of what kind of trailing stop do you want to use. Do you want to use dynamic, LCC? What's more profitable? So you can actually say, hey, I just want dynamic each and every time. You don't have to optimize anything. My preference is to optimize dynamic as well as the compression and let one override the other. I want them both to work. A lot of times in the live trading room, you'll see we get a dynamic 1 minute. One trades the dynamic works, and one time it's it times out, meaning max trade bars hit, and then another time it's the compression. So I think it's a combination of when you're trailing a stop, what do I want? I want kind of like, I can't be around the trade one too many bars, because then, odds favor the trend's exhausted itself. A. B, I also want a trading stop function. So when we get back to more historic norms of a market, and I'm not sure when that would be, but when I'm talking about the equities here, the equities, we're not at 250 points in the E-mini S&Ps. Again, ES. And again, it's not going to show my arrow, so maybe I could just draw, and it'll show that. All right, so at that point, that's 200 and that's the 7-day was 250 points, S&P points. I mean, if you think about it, over the last, on average, there's 19 S&P points. that's 22 points, and that goes all the way. I mean, wow, that's 2018 right there, gang. So that's 1 year. That's, again, 2 years. The average of the market in the last 2 years is, you could see you're probably around 30, 28 points on average, not 121, which is right now, which is a lot less. It's half of what it was at the middle of March. So and that's a 7-day ATR. So again, understand the environment of which you're in. You can't ignore, yes, in times of even back here, which was a pretty volatile sell-off in the marketplace, right? The ATRs were elevated, but nothing like they are now. So how do you back test a strategy that says, give me the best profitability in the last 2 years, and let me apply that in this environment? Well, okay, if the last 2 years, the highest ATR was maybe 90 and the low was 14 or whatever it was, right? I think it was 9, I think, at one point. So somewhere in the middle, I want to develop a backtest study for the last 2 years, and on a 5-minute basis, you're going to have thousands of trades. That's ridiculous. Make sure, if you're trying to build a backtest, a strategy, that you're building the strategy for the environment you're in, because your equity curve will look totally different in this past environment than it will right now. Your settings can't be the same. How do you have a trailing stop function? How do you risk $300 now? What is the mindset of having a $300 stop now in an ATR of 121 points a day? All right, that concludes our time together. I hope I was helpful and answered your questions. There were some really good, by the way, Brian, really good questions. A lot of people may have the same type of questions as they build a strategy, and also what the function is, which one do you want, and a better explanation of what are those three between the last conditional change, the compression, and the ATRs when it starts to kick in versus dynamic. Thanks for joining me tonight, and until next time, that's our PUG group meeting for the Algo Optimizer. Thanks, gang.